Our next panel is AI and Credit, How to Recession-Proof Lending. Our panelists will be Sara Breyfogle, SVP and Chief Credit Officer from Discover Financial Services, Ray Duggins, CRO of Octane Lending, Agus Sudjianto, EVP and Head of Corporate Model Risk from Wells Fargo, and Pankaj, CEO of Scienaptic.
I'm sitting this side, I guess, yeah. I think, Ray, you want to do that one? Good afternoon. Pankaj Kulshreshtha, I'm the CEO of Scienaptic Systems. We are an AI-powered credit underwriting platform based in New York. But my panel here is a lot more interesting, I think. Sara Breyfogle here, she's the Chief Credit Officer for Discover Cards. Ray Duggins is Chief Risk Officer for a fintech startup called Octane Lending. But before that, he was Chief Risk Officer for Standard Chartered and GE. Agus, who heads Model Risk at Wells. So we have wealth of real risk management experience here. And here is the inspiration for the theme that you have here. In very early stages of my career, when I was still actually building models, propensity models, PD models, and stuff like that, I had the fortune to be part of this vision, which is a little bit similar to what is going on with respect to AI and credit decisioning. And there, the vision was very simple, which is we're getting data from multiple sources, we'll bring it into a machine which has large number of models, propensity models, loss default models, and so forth. And all the collections and operations and stuff like that will be outsourced. And really, in effect, this will become a perpetual motion machine or perpetual money-making machine in financial services sense. And actually, that vision was operationalized. We built a bunch of models and actually started originating the business. We built a $2 billion business. And several of us actually went on cruises and stuff like that at the end of it. Ray here will remember some of that. And then we started having problems with the portfolio with respect to losses. In the end, that portfolio shut down and so forth. So the reason why we want to talk about a slightly different perspective on AI in credit was because we are getting into potentially low growth times, if not recessionary times. And this time, if we don't create a success out of AI, it will be the fall guy. And we have a lot of interest in making sure that businesses succeed using new data that is becoming available, using new techniques that are coming up because of the whole evolution of AI and machine learning that is going on. So what we are trying to do here is, on this table here, there is over 100 years of experience, and I have not considered decent to count the number of years of experience, but definitely 100 plus. And these are people who have actually run risk management in financial services companies, seen a bunch of cycles, gone through that experience. So what we want to do is, we want to give you a balanced perspective of how to kind of stay between an irrational exuberance and somewhat total ignorance of what is going on in terms of excitement. We ourselves at Scienaptic, in our work with 12-odd banks, financial services companies, as well as with some fintech players that we are working with, we consistently find, somewhere from 10% to 25%, depending on the situation the financial services company is in, additional approval rate at the same risk cost, basically. So the opportunity is massive. There is no question about it. But we have to do a bunch of things together to make sure that businesses actually create a sustainable profitability rather than taking swings one way or the other. And that's the topic of this discussion. So with that, I thought I'll kick off this discussion, and stories are always good to hear. So I thought I'll just ask all of our panelists to actually talk about their own experiences of cycles. What was going on, what was the key learning from there, and stuff like that. And then we'll take it from there. So, Sara.
So during the last recession, I remember very well because Discover actually had just spun off from Morgan Stanley in the summer of 2007. So Right after that starts the greatest financial crisis that any of us will remember. And we were suddenly a standalone company without any deep pockets of anyone else. And I would say we were kind of scrappy at the time is probably an understatement. But I was leading the portfolio management team, and it was basically a brand new company, accelerating loan losses. And every day you went to work wondering if it was going to be your last day at work and whether or not the company was going to go out of business. But it was a time that you learn great lessons in how to manage through big cycles of risk. And we had to try many, many different things that we hadn't necessarily done in the past, some of which worked and some of which didn't. But probably the key difference, that cycle versus this one then, is how to better prepare. Back then, the level of the economic cycle was extraordinary, and I'm not sure it's something you can ever prepare for. But obviously, since we've had a much longer time now, this is sort of the path that we're on today.
Okay, as you can tell, I've been doing this for a long time, probably 42, 43 years in terms of consumer lending. And in my role in consumer lending, I've done it around the world in terms of Southeast Asia, Middle East, Europe, Africa, and obviously in the U.S., both at GE Capital in terms of the Chief Risk Officer for Consumer Risk, and at Standard Chartered Bank for the Chief Risk Officer of the Consumer Bank, and at American Express. And at one point I thought I'd seen everything, but you can't say that. There's always something new that's going to come up that you'll see again, or you haven't seen before. But I thought back over some of the things that I've experienced in the past, and sort of looked at how they happened and what had happened, and I thought it'd be interesting to share some of them with you. And I'd like to come back and talk a little bit about what we're doing today, which is a little bit different than the past. One that immediately comes to mind was when I was at GE, we had the Walmart private label credit card. And this was in the 2010 cycle, and it was pretty severe. We had to really pull back in terms of what we could fund. In fact, we had huge difficulty funding overnight and all kinds of stuff going on. And we really had to go back at how we could control the Walmart portfolio in terms of line control, in terms of size of line, in terms of size of outstanding. We did various scenarios in terms of looking at term of loan, looking at how we could pull line back, and did a lot of champion-challenger type tests and calling the customers and finding out what happened. And as we called the customers and trying to figure out what their concerns were as we were going through this, we found that they didn't mind having their lines cut down, they didn't mind everything we were doing, as long as they had sufficient open to buy to pay for their pharmacy bills. So this is sort of the Walmart demographic that we were dealing with. They wanted $100, $150 to pay their monthly medical bill, pharmacy charges. And so this would have been a fantastic machine learning AI type concept. If we'd had that kind of data at the time, we could have seamlessly and automatically done some of these things. And it turned out we found a very good, valuable customer group going through this sort of situation and going forward. And then I go back to some of the experiences that I've had in Asia. And in these scenarios, it's less managing the portfolio to a certain extent because they're more inspired by perhaps misguided fiscal policy by some of the governments involved. One was when I was at Standard Chartered in Malaysia. The Malaysian government or financial authorities decided that personal lending was way too hot, too much personal lending going on, and overnight they decided to restrict personal lending. And it wasn't overnight, maybe about 2 or 3 months. And so it was announced personal lending was being cut down. It was going to be severely curtailed in terms of the amount that could be loaned, the number of loans that could be out there. And so the market went crazy, just crazy, everybody getting a loan as fast as they could. And then they came in with credit cards, and credit cards weren't subject to all this, and so a lot of very poor quality credit cards came into the market. And so instead of stabilizing anything, they created a mini financial crisis in Malaysia where there was no income capacity to support any of the loans. They put some very, very misguided extensions and modifications to existing loans out there to try to get people to survive, and created a terrible, terrible mess. So obviously, Standard Chartered had huge resources, was able to withstand the capital calls and all that kind of stuff, but a lot of banks weren't able to, and it was really, really very messy. The other one that comes to mind to me, and again, I don't know the exact machine learning model for predicting what a government will do. It's something we haven't really looked at yet, but essentially in Japan, there was something called a Sarakin loan, which was a salaryman's loan. And it was really run on the gray zone. It wasn't really it's a loan you went to when you didn't go to a legitimate bank. And the APRs would go up to, I think, 29, 30%. And overnight, it became in that these loans were imprudent, that they were being very, very unfair to needy customers. And essentially, the rates were cut back to 18%. And by the way, this is a 40% return on equity business, too. The rates were cut back to 18%. And customers who'd had loans for years were able to reclaim refunds on the difference in the interest rate. So it was huge, huge impact on the banks that were doing this, huge impact on the organizations. It was also at a time, again, when delinquencies were up in a big way, and probably, I don't remember the cycle, probably 2007. And so essentially, the government wiped out a whole sector of the banking sector. And the one thing learning from this is don't trust a 40% ROE. It's too good to be true, and it's not going to last. So just be assured of that. So those are some examples of the past. And I'll go very quickly and just tell you a little bit about Octane Lending. Octane is a power sports lender. We lend money for people to buy motorcycles, ATVs, UTVs, personal watercraft. We are a fintech, and essentially our loan origination system is really the big tech of this. And we've been doing a lot of debate whether the cycle is coming, what's going to happen, how do we prepare. And we're very, very conservative in terms of our stress testing, which is number one. Number two, we're very flexible in our underwriting in terms of always being prepared. We underwrite in modules where essentially you have to go through a FICO Auto 8 and pass a threshold. Then we have a series of bureau hard cuts that we can turn on and off depending on the environment and how sectors are performing. Then we have an in-house custom logistic regression score, which will essentially determine the offer. Waterfall down the LTV, the size of the loan, and the rate that you pay in terms of your credit quality. And so essentially, as we see the cycle changing or performance changing, we can flexibly change these sectors and modules and actually tailor the underwriting to what is happening in real time. And so far, we've been very successful doing that, and it's worked in a very, very good way. The second thing is we are now designing and about to put in a machine learning collections model, which to me is very, very significant and exciting in terms of, essentially what it will do is project the propensity to pay. And I think it's going to have a huge game changer for our service center in Dallas in terms of obviously driving collections efficiency, but also driving operating efficiency in terms of only searching the people that you need to contact to pay and work. And I think it'll be a huge change for us. But right now in the cycle for us, the biggest thing is the liquidity of the capital markets. We fund our business through warehouse lines and shortly through asset-backed securitization. But we really have to make sure that we are funded in such a way and we have committed lines that we could get through a cycle should it happen and should the downturn be there. And so far we've been very, very successful in doing that, and we feel very, very confident that we should be there. But this is probably the biggest factor for us in terms of recession, is the liquidity of the financial markets as opposed to the quality of the portfolio. I've probably talked too much. Go ahead.
Thank you. I'll share my experience a little bit. For many of us who've been through this, particularly in the 2006, 7, 8, and so on, and myself at that time, I was with one of the largest bank in the US. I was with Bank of America, and then I moved to Europe. So experienced the Euro crisis when I was working as one of the UK banks, and then came back to the US after that. For many of us who've been through this one, it's a very, very tough subject and very, very humbling subject. Let's put it that way. This is something that I am personally thinking a lot about this, as we are. The question is only when is this going to come? It's something that, considering what we learned from the past, and with my background in modeling and machine learning, is the least thing that I am worried about is if this next time around the blame will be on the machine learning and AI, and so AI and machine learning will be dirty word that nobody want to be associated with, and that's something similar to in the past. It was the blame on the Gaussian copula. This time the blame can be on the machine learning. And this is something that I've been thinking a lot about this, and in particular because all the statistical model, machine learning included in there are really about correlation and not about causation. And correlation will change, correlation will break when time is bad. So that's one thing. Secondly, the things that I call it as heterogeneity or frailty. Everybody look very healthy and beautiful when they are 18 years old and 20 years old. Everybody looks healthy and beautiful. When they start getting my age, getting past 50, then things start getting different. So people have different kind of frailty. The heterogeneity start show up. People have a good gene and good healthy lifestyle will be aged very well, and the other don't age really well. So credit is something similar, and we have to deal with frailty. We have to deal with heterogeneity. And frailty and heterogeneity for credit is a function of macroeconomic factors. And when time is bad, things that look very very homogeneous today, in a good time, everybody will pay their loan because everybody else will give their credit. It will change very, very dramatically different when the musical chairs stop. So that's what I'm worried about. I think Sara and I talked about this before the session. We saw it in front of our eyes when what we call it vintage curve or maturation curve looks like something that defaulted in the 5% annual rate, it can jump to 35% default rate. That you can see, and that's mathematically will be like that too. I cannot help myself on the geek side, because mathematically when we start talking about frailty model, that's what will show up. The frailty, the heterogeneity will show up. Your default rate will spike very, very dramatically. So 5 times or even 10 times the usual default rate is not very uncommon during the when times going bad. So this we saw it, this movie before, and I don't want to see it again. So this is what we really thinking a lot about this, how to deal with heterogeneity that will show up during the bad time.
This is a massive point, Agus. Thanks for that. In fact, I remember in the portfolio that I was giving you example for, eventually we landed up at loss rates of something like 25, 26%. And when you looked at the pro forma, it was like 4%, and actually the stress testing was done up to 5%, 20% variation over your pro forma losses, and portfolio was still working. So nobody actually anticipates the order of magnitude difference that you can get if some of the fundamental principles of your lending platform are not right. So in fact, more than my own questions, I think there are a bunch of very interesting questions that are coming up on the board here. So I might take some of them and direct it to respective people on the panel. So this one is for you, Agus. I think a number of online lenders use machine learning on limited data sets, not full cycle. What challenges could this pose to the market in a downturn?
Can you repeat again, sir?
Number of online lenders use machine learning on limited data sets.
Yeah.
What challenges could this pose?
This is something that I cringe all the time. When we look at the data is biased, we know the data is biased, and it's biased on the and a lot of credit scoring. It's trained based on most recent data, probably 2 years old, 3 years old type of data. In a good time, everybody pay. Yeah, in a bad time, totally different. And all the machine learning model that we have, none of them capture the frailty. None of them model heterogeneity. So we do not know, and in there, it doesn't have it. So for us, this is what very important is, if you want to drive car really fast, you want to do this thing, you need to know when to brake, you need to have a good navigation system. And that you need to have model that will be able to capture heterogeneity, will be able to do that. And they're required to have longer historical data. That if you want to do that, my advice is make sure your stress test model need to be really, really good. Your stress test model need to be able to capture heterogeneity, because this nightmare, I have seen it before, and for sure it will show up again, because mathematically just that, some of you that have statistical background, talk about the gamma frailty in the survival analysis, is just like that. So this is what I'm worried about. When we prepare in the turn like this, I think Ray mentioned very, very good points. It's the time to build machine learning for your collection model, not to build machine learning for your origination model, right? So that's a very, very important. If you do machine learning for origination, we've seen this before, okay? So build machine learning for collection model, the back end, how to do portfolio management.
Yep.
Yeah, you can see where my focus is, yes, exactly.
In fact, Sara, when you and I were chatting, I think you talked about a very interesting aspect of what machine learning implications might be, and that was with respect to simplification. So do you want to tell a little bit more about that?
Yeah, I mean, what we found in machine learning models for credit decisioning, so particularly underwriting, historically we've ingested, multiple credit scores, additional credit bureau attributes, some customer-provided information. We've put them into big sort of decision trees, made decisions on, the ends of end nodes on many different segments, and that can be incredibly complicated and difficult to monitor and ensure they're performing as intended. So with machine learning models, essentially all of that information now can be captured, and we've been able to radically simplify then the decisions that we're making so that, most importantly, as I'd mentioned before, we can much more clearly actually see the performance of each of the segments and the performance on the margins so that then you can react more quickly as the performance starts to change. So much, much better in terms of speed of reaction.
That's right. And this one is for you, another question from the board here. ML underwriting ideally captures credit risk. What about other risks that may not be modeled by online lenders like market liquidity risk? Will they survive? So that was a little bit of...
Could you say it again? I couldn't hear you.
ML underwriting typically captures credit risk.
Yeah.
The question is being asked about what are the other kinds of risks, especially things like liquidity risk, because of which the existence of the venture itself.
Exactly. That was the whole point I was making earlier. I'm much more concerned about the liquidity risk than the credit risk and the quality of the portfolio. We've used all the true known techniques to manage the quality of the portfolio. We've got, as I said earlier, very flexible ways of managing it. We are going to put the machine learning collections models in. But really the unknown is how do you manage the liquidity risk? And we're really just planning ahead. We're not going to wait for everything to dry up and stop. We're trying to get the lines committed now. We're trying to get committed lines. We're about to go into the securitization market. And we're really, really focused on getting ourselves protected for the next 12 to 18, 24 months, whatever it might be. And that's the main focus. We have capacity in terms of where we are right now to stress the portfolio up to 2008, 2010 levels from a credit point of view. But really, we need to make sure that we can sustain and keep the business funded and going forward. And right now, we're very, very confident that we're going to be able to do that through all the planning we've been doing over the past probably, I'd say, 6 to 12 months to get to the point where we are today.
Right. And another question, I think we have probably time for just this one. And Agus and Sara, if you have thoughts on this one. Have regulations, fair lending regulations, caught up with AI? How do you manage regulatory expectations while driving enhancements in AI?
I could say, from our side, we have to do the same level of due diligence in terms of fair lending assessments in our models. It has become certainly more complicated, and I would say at least initially as we've rolled out machine learning models, the amount of time that we've spent on fair lending reviews has been much longer than what we'd spent in the past. However, I think with each iteration, then we're able to do that better. But clearly, I think even the regulators struggle with this to some extent as they're not as educated on the techniques as well.
I think on credit is very well established, very well developed, and people have very, very good practice. We have Reg B that everybody have to follow. So fair lending is model has to be checked in terms of fair lending. When you start using alternative data, you have to be very, very careful. Like for example, if you use a number of clicks, because we have explicit bias that we can check, but then we have implicit bias that you have to be very, very careful. If you start looking at the marketing and all those things, number of clicks, number of clicks will relate to demographic on the age, so you have to be careful, you have to check. So the importance of you start using alternative data in credit, we have very, very established process. The problem that we see is things that beyond credits. That's the bias, the things that not governed by, regulated by Reg B. So those are the things that keep me awake at night as a chief model risk. It's really the bias, the discriminatory for things that outside lending.
Thanks for that. I think that's all we have time for. There's a lot of wisdom here, so catch them by the side of the conference and leverage their experience as you build out your financial services businesses. Thank you.
They'll take that down.